So welcome back. Today we're continue our talk about where should you put your money, and we will be focusing on insurance today. And the last two videos, of course, we dealt with RRSP and TFSA. Glenn, thanks for being here today.
Thank you for having me back. My pleasure.
Great. And for our first time viewers, I'd like to take just a brief moment to introduce Glenn. Glenn is a financial advisor as well as an infinite banking practitioner. And I probably should mention that he's an authorized infinite banking practitioner, and he offers customized services to help you be more efficient in your finances in your life. And I know most of us could use some extra help in being more efficient in our finances, right? So Glenn, I'd like to continue just the same format today as we have been doing in the last two sessions, and just make this like a question and answer session by asking some frequently asked questions, and then you can answer those, of course, right? And you can always add some more information as you see relevant. Would that be okay with you?
That'd be great.
Great. Yeah, so in continuing with our theme on where to put your money, as we're going to talk about insurance. And I know that there are different types of insurance. So Glenn, can you put your money in all insurance?
No.
Okay.
So there is the most popular type, which is called term insurance.
Mm-hmm.
And think of it kind of like your car insurance. You spend your money on your car insurance, your PLPD, whatever, right? But if you don't make a claim, it's gone. But it covers you for the time that you need it for. Term is very similar that way.
All right. So can you tell us which insurance you can put your money in and which ones you cannot? You just said term, but can you just expand on that a little bit more for viewers?
So there's permanent insurance, which is stuff like universal life and different types of universal life. And there's also whole life, and there's a couple of types of whole life as well. All of those have components of being able to have cash growth in them, and the growth can be tax-free as well.
Okay. And then term, on the other hand, would not have any kind of cash component to it then, right?
No, terms like you go out and rent a car. You could rent a car for a month. It's lovely, you get used to it, but at the end of the month, you have no say in it. You have no equity in it. You just give it back, right?
Okay.
Whereas with the others, you build up equity over different stages, and that can look quite different as time goes by, but they at least have the opportunity to, where term does not.
All right, good. And I guess I'm just thinking for my own self, I have a life insurance, which I pay more for as opposed to a term. And now I'm seeing why I'm paying more for that, because term does not offer as much benefits. But I guess I'm not going to jump the gun. I'll let you go into that, later on in the video. But before we get into our next question, I'd like to just remind our viewers that if they have not done so already, just to take a second to hit that red subscribe button and turn on your notification bell so you can be the first to be notified of our new upload. All right, so Glenn, why do I need life insurance?
Why do you need life insurance? That's a great question. In my opinion, everyone needs it because they've got something that they've got to cover, right? Now, someone who's a single professional might look and say, I'm single. I like being single. I don't have any intention of changing that, and I definitely won't be having children. So why would I really need insurance? Well, in its purest form, you wouldn't. But with cash value insurance, what we found is it's been more of a want product than a need product. And I'll explain that. Your money that you deposit into insurance, at least over and above the pure cost, your money grows in a tax sheltered environment, right? Done right, you've got either lifetime payment options or you've got limited payment options. But done right, you can build up substantial cash within these products that you can later access to help you supplement your retirement, and do so in a more tax efficient manner than some of the other programs we have going on. So in cases like that, it could be a want product as opposed to a need. In most cases, there's going to be a combination of both though.
Okay. So I'm trying to figure out, so you're saying then that the term insurance that doesn't have really a cash value, for me, if I was a single person, then that would be the person that I'm leaving behind when I die. But for this insurance that you're talking about with the cash value, I can actually reap some long-term effects from when
You
I'm
can.
alive now. So you're saying that with this cash value, I'm able to get effects from it, benefits
You
from it
can.
while I'm alive.
Yes,
So it's
that's
a good
correct.
thing to have it.
So again, no, it's a great thing. So good. I mean, when you talked about the term, let's put it this way, even families, most people with families have at least most of their insurance is term. And the bottom line is it's the most affordable at the time,
Okay, right.
right? Renting right now can be the most affordable at the time. Now, over time, having to pay extra things like property tax and house insurance if you're going to buy a house, it costs more, but you're also in a position now to build up equity. That is kind of the similarities with a permanent plan as opposed to just having term, right? You can pay to live because we all need to live somewhere.
That's
Shelter
right.
is the need, coverage is the need, right? But where that shelter is and the extras you might have and to build up some equity, that's the want part of it. And that's where using cash value insurance can become a want product as well.
Okay,
Right.
perfect. And did you want to talk on any other benefits that people could get from having a life insurance?
Sure. So I'm gonna focus more on whole life because it's a little bit more predictable. Now, one of the other types is universal life, and you can set that up with small costs at the beginning that escalates to large costs at the end, or you can set it up with a level cost, right? You can choose to have you pick funds that could fluctuate up and down at the markets. That's a little bit more unpredictable. Whole life is fairly boring, but that is part of the beauty. So I'll give you an example. With a whole life policy, if I've set up one, let's say I do one that I'm going to pay for over 20 years. Okay, I know what my costs are for 20 years. I know there will be no surprises. Nobody's going to come and say, well, performance in the market doesn't go as expected. So you got to pony up some extra cash. Otherwise, this could be going away. Nothing like that. One of the great costs is one of the great things about it is the guaranteed cost structure. So you know from day one what this thing is going to cost you for life. Right? Now, there is base whole life. There is additional deposit whole life, which is primarily what I deal with. Right. And I won't go into too much details on that, but we'll say this. There is no one who's going to have a participating whole life. I'll call it that. No one's going to have a participating whole life policy for 10 years, pay for it, and miss a payment for 3 months and lose it. Because they have built into them what's called non-forfeiture guarantees, which means that if you can't come up with money to support it after a certain amount of time period, there's enough cash in it that it can maintain itself. It'll just automatically borrow from the equity. Don't we wish our houses could do that, right? So you got more flexibility there, right? So that is one of the most beautiful things about it because life happens. Again, I keep using it as an example. Nobody saw COVID coming. Look at all the adjustments that people had to make because of COVID. If you've got something that's got built-in equity and built-in non-forfeiture clauses, as they call it, where if you can't afford to pay it, it does just automatic premium loan. Let me borrow from the equity. Think of a house like that. Think of if you had a house for 20 years. You've been paying that mortgage, never refinanced, and you go 4 or 5 months without paying. What generally happens?
Then you're going to
somebody
go
else
at some point.
Yeah, you're going to lose that. Yeah. That cannot happen with a whole life policy that's in effect over the same period of time. Not for that quick a time. It would have built up enough cash in it, and a non-forfeiture clause of that is that, guess what? You can get access. You're going to have that as a default payment. So that in itself is one of the huge benefits because life is unpredictable. And the older we get, especially when we stop working, unpredictable seems to come more and more frequently, right? So having something like that is fantastic. Now, another addition to that is we almost call it like a little bit of built-in indexing. I'll explain what I mean. If it's a paid-up addition, as we call it, dividend-paying whole life, over time, you're going to have dividends. Dividends increase your death benefit. So you could start out with 100,000, and you could technically in 20 years have more than double that in coverage. You're like, How is that possible?
Mm-hmm.
Because it's kind of like you're building a little bit of a shopping mall or strip mall. You've got your base building, and each year there's a profit. You do an addition. And that addition comes as its own little store that
Mm-hmm.
you can rent out and get some more cash off of. That's kind of whole life. Each year you get a little bit of a dividend. It buys what's called paid up addition. So it's a piece of permanent coverage, another piece of whole life that's already fully paid off that generates a little bit of cash value. So not only do you have your coverage that doesn't decrease that way, it will actually increase over time depending on the type you have. So it's important with the setup, right? And another great thing is guaranteed loan options.
Okay.
Yes, guaranteed loan options. If you're self-employed or if you make less than the bank willing to lend is comfortable with, you know getting a loan can be tough. Well, if you got, let's say you've had your insurance for a while and you got 40,000 cash value in that thing or 400,000. But let's say you got 40,000 and you need a $20,000 loan and you can't seem to get it from anywhere else. All you have to do is just contact the insurance company and say, hey, I see I've got 40,000 cash value. I need access to 20. You know what they're going to ask you? They're going to ask you, where do you want it? Check or in your bank account?
Nice.
And within 2 week stops, could be a couple days up to 2 week stops, the money's there. No qualifying, no showing up on your credit bureau as a loan because the cash is secured. It cannot go negative with market conditions or anything. Once it's there, it's vested, locked in, and the access is there for the owner. So many, many guarantees, many, many positives of having that set up. Now, I'll tell you right off the bat, to get all of those guarantees, just like in life, you expect that, yes, we're going to pay for the same amount of coverage as a term or even a universal life. It costs more, but there's a reason why. You're going to be way better protected as far as options and way better protected as far as access as you go forward. All right. So I could go on and on about this. You can tell. I'm going to just leave it there and see what other questions you have, Genese.
Oh, yes. Yeah. I mean, those sounds like some really, really good benefits. And I'm sure this is an eye opener for a lot of people, right? Just listening to you now. But as you talk about the benefits, I am thinking there has to be some risk. So what are some of the risks that you get from putting money in insurance?
Well, I'll say this, and now I'm going to switch to universal life a little bit. We're going to use it. I like using housing and insurance as parallels for some reason, right? Right now, our housing market is hot, 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 fire. Now, if you decide that you want to go get a house, what's your reasoning? Am I trying to get one because I'm worried about missing out? Or am I trying to get one because I need one and I think we're in a position to take care of it? Because it does matter. So let's say I jump in because I think I'm missing out. Use my last dollar for that down payment, hoping everything goes well, and I get laid off in 4 or 5 months. If I can't pay my mortgage for 4 or 5 months, I've lost the house. Well, you can be put into an insurance program that you really can't afford for your situation. Okay. So it's key to make sure that you're working with somebody who knows what they're doing. And if you're doing whole life set up this way, you use an authorized infinite banking practitioner, because we're going to assess and make sure that even though this is a great program, it may not be right for you at this time. Right. Hence part of our topic of different places to put your money, right? In the short term, it might be better to have some term, and it might be better to just put some money in the TFSA for flexibility in the short term. It depends on your situation. And then as you build up and you get a little bit more substantial, where you've got things looking a little bit better, then we can look at converting you into something like that possibly. But it's very important that you get set up right. So yes, when you talk about drawbacks, you can be put into something that's a little bit rich for your blood, right? And again, if the same scenario happened, if you can't keep it, then it wasn't a great program for you to begin with.
Right.
So those really, especially when we talk whole life, for the drawbacks. With universal life, depending on the company and the type, there are what's called surrender charges. So I could put a lump sum of money in a policy and thinking, you know what, I could get it out or get it out by a loan. Well, it depends on the formula. I may not be able to get out more than 10% of that money. or even that depending, because some of the companies have a surrender charge that can last on a schedule of up to 10 years. So you can never get access to your full cash in there for a good long period of time. Well, that's no good if that's all the cash you had and it's tied up there. So you have to be very careful of what you're getting put into and what your expectations are as far as that product goes. So it's very good to make sure you're dealing with somebody who knows what they're doing, so that not only on the good side of things you can benefit, but if things don't quite go as expected, you know you have options.
Right. Oh, perfect. Yeah. Well, thanks for that. And you did mention, people want to cash out. So I wanted to find out, like, if you have the money there, how do you actually access that money?
So there's a few ways. Okay, as you build up cash value, there's a few ways to do that. The least efficient is to just cash some out. So again, I'll use some whole life now. So let's say, I've got a policy and I've got 50,000 in cash value. And I'm going, okay, I need access to some money. Loan is such a dirty word. I don't want to do a loan. I want to cash out. Well, you could. Cashing out gives you the cash value, but it kills the insurance.
Okay.
And it stops any compounding. Additionally, depending on where you are in that schedule, you may now have made that 50,000 taxable, or at least a part of it. So it's really important to make sure you know how you're going to access, why, and what the consequences are. Okay. So there's a possibility there. The next thing, and I use the word loan, loans can sometimes seem like a dirty word, but a policy loan is a beautiful thing because you don't have to qualify.
Okay.
You don't need a credit bureau hit. You're not going to be, nobody's checking your credit score. It's just, if you've got enough cash to justify the loan, the insurance company just forwards the money to you. That's it. And oh, by the way, did I mention that they are open-ended loans? What do I mean by that? Well, you don't have a minimum payment to make.
Right.
They don't say you have to pay it back in a year, 3 years, 5 years, whatever. You may not have to pay it back ever. But again, you want to make sure, depending on the parameters, that interest is charged. So you want to make sure that you're not going to let that thing collapse on itself. So that's why working with someone who knows what they're doing is paramount. But you do have options, or you have the option to also assign that policy to a third party, because maybe your bank's going to give you a little bit better rate. Now that may include it showing up on your credit at some point. So you got to weigh what makes sense for you. There may be a little qualifying there, but it is a possibility. With the policy loan, they're not asking. So for people who are self-employed, these are really, really good, because what happens? Your accountant says, we're going to try and write down as much as we can on your taxes so you pay less. So we're going to keep your income low. Now that's good in one way, but when you need a loan, a low income doesn't help you.
That's
So
right.
if you've got it built in a reservoir that you can access without having to qualify, then you don't have the same issue. And let's say you're buying a business, or you may be buying a rental property, or whatever. Maybe you're buying an asset that you could be selling in another 2, 3, 4 years, but there's no cash flow coming off of it. Well, if you can use some money without having to make a payment, that gives you way more flexibility, right? And then if you do sell that asset, we say presumably for a profit, you've got a place to go put some of that money and shelter it as it grows some more.
Right. Wow. Wow. I mean, powerful information, Glenn. I mean, I just want to ask our viewers, I mean, if you're really enjoying this information, please remember, just give us a thumbs up, leave your comments below, because next week we're going to be wrapping it all up, right? And we're just going to do a recap on what we have discussed before. And then, the topic is, just a reminder, we're discussing where to put your money. We discussed TFSA already, we've discussed RRSP, and now we're dealing with insurance. So just make sure, I mean, if you have any questions, any comments, anything that I did not cover here, just put your comments below. Let us know, because we really want to answer your questions. We really want to make sure that you are efficient in your finances in life, right? So whatever we can do to help you with that, this is free information for you, no cost. So just put the comments below and we will get to you. Glenn, is there anything else that I have forgotten to ask you that you want to mention to our viewers that we haven't touched as yet?
I was chatting about the options with a lawyer buddy of mine earlier, and I told him, you know what? I love talking to you. And one of the reasons is you're staying step for step, and it all makes sense to you. Now, unfortunately, for the typical person, this is a lot of information for a totally different asset class, and you probably are glazed over. Don't let that keep you from getting more information, right? You could have access to a tool that can benefit you, said that right, you, so much while you're alive and still here, giving you flexibility and access to money that grows in a tax-free environment, that grows in a non-loss environment, meaning because it's cash, it can never go negative, right? And you can have a bunch of options available to you. But I do know that it's a lot of info. I might have lost you earlier, but if you're curious, let's chat. And I can slow down and make sure that we talk about how we can get you to use that to your benefit. All right, so for more information, please contact me. I'll gladly go through that with you and show you. One of the things I love, Genese, is when I'm talking, I know I see that glazed over look and I know, okay, bring it back. But my favorite look is when the eyes start opening wider, because it's like, what? This is possible?
Yes.
Yes, it is. Yes, it is. So for your eyes wide open moment, contact me and we can chat some more.
Perfect. What a great way to end our discussion today, Glenn. And this is all we have for today. So we will see you again in our next video. Okay, so bye for now.
Take care. Thanks for joining us.